Here are my top 10 stocks to buy right now, half of which I'm actually investing in my portfolio. That's right, in this video, I'm going to be showing you one stock that I own, followed by one stock that I don't own, and working my way up to my largest overall position and my favorite stock to invest in right now. Hopefully this list gives you some ideas for your own investments and a starting point where you can branch off and do your own research, because one good investment could change your life. Just look at Warren Buffett. Now, to show that I'm not pretending here, here's my actual stock portfolio and how it's done over the past year. We can see that it's mostly flat, but up a little bit overall for the year. So the first stock I'm going to talk about is one that I don't own, but one that has a really interesting story behind it, MongoDB. If we look at MongoDB's earnings over the past 4 quarters, they've been growing at over 30% per quarter for over the last year. And while they are not yet positive in terms of their net income, it does seem to be trending in a good direction overall. Now, MongoDB offers NoSQL databases. So you can think of a SQL database kind of like an Excel spreadsheet. It's sort of rows and columns and everything's neatly put away in its exact spot. NoSQL databases offer you a lot more flexibility, where you don't have to specify exactly what the data looks like ahead of time. The reason this is important is most data doesn't look like an Excel spreadsheet. It's messy and unstructured, and it fits better into a NoSQL database. Plus, NoSQL databases can tend to be even faster than SQL databases. This means that a lot of developers, especially at startups and cloud-native companies, tend to lean toward NoSQL databases, especially as they're getting off the ground. And this is one of the reasons that MongoDB is growing so quickly. Hey everyone, welcome to FinTech. If you find anything valuable in this video, or you decide to look into a stock more, just leave a comment and let me know what you found. Now, the next company I'm going to go into is a stock that I actually own, and that is Sentinel One. Now, I currently own 582 shares of Sentinel One at a value of just under $10,000, and that's actually down $8,000 off of my initial investment of nearly $18,000. And that's mainly due to a sell-off in both growth stocks, as we've seen higher inflation, and tech stocks in general over the past couple years. Now, Sentinel One is a security company. They basically offer AI-powered security. You can almost think of them like a super advanced antivirus. Traditional antiviruses will basically look at all the previous attacks that they have in their database and compare it to new potential attackers to decide, have I seen this before? And if I have, I'm not going to let it in. Sentinel One goes one step further, actively predicting attacks before they even happen. And they offer their services primarily to enterprises and large businesses rather than consumers, meaning that they're less affected by things like a recession than a consumer-facing company would be. Sentinel One is also growing incredibly quickly. A year ago, they grew their revenue 109% year over year, then they grew at 124%, then they grew at 105%, and in their most recent quarter, they grew their revenue at over 90% year over year, basically doubling. My next top stock is another one that I don't own, and that is Enphase. Enphase is a solar company, but unlike a lot of solar companies which aren't actually making any money, Enphase is making money hand over fist. If we look at Enphase's recent earnings, which these are actually outdated by 1 quarter, but they were growing 75% year over year, then 80%, 67%, and 46% before that. Now, in their most recent earnings, Enphase reported pretty weak guidance going forward, and because of that, their stock price has dropped pretty dramatically over the past day. We can see that it dropped around 25% basically overnight on Tuesday, April 5th. Now, this could be due to the company fundamentally struggling, or it could just be a sign of Enphase facing some temporary headwinds. It's hard to tell without diving into the company further, but I do think this is a company that's worth looking into. A few of the points in favor of Enphase is that they provide products to the growing solar industry, which is only going to get bigger every single year. They're also expanding outside the US and into markets like the EU. And while doing so, their expenses are only around 12% of their total revenue right now, which means they're running a very efficient business. Now, this is still a small company and they are very hardware dependent, plus they have a pretty high valuation, so those are the risk sides that are potentially weighing down on their stock price in the short term. Next up, we have another stock that I do own. And by the way, stick around until the end of the video to see what my largest overall investment is. So next up, we have SoFi, which I currently own 1,900 shares of at a value of just over $10,000, and this is also down, but only a little bit, at around 10% off the $12,000 that I initially invested. Now, you may notice this F to the side here. This is a rating that Charles Schwab gives to different companies, and as far as I can tell, it's mainly based on valuation. Now, I don't put a ton of stock into this number because in the past, I invested in a company called CrowdStrike, which made a 300% return for me while having an F or a D rating the entire time from Charles Schwab. So if you're investing in higher growth companies that have higher valuations, Charles Schwab's just going to rate them lower. Now, SoFi is trying to become the next generation of banks, taking on the 500 million bank accounts that currently belong to legacy banks and trying to bring them into the 21st century. They're really 3 businesses in one. They have their lending business where they make most of their money. They have their technology platform where they're trying to build the backbone of the future banking system. And they have their SoFi Financial Services, which includes their app, SoFi Invest, a lot of the services that you may have seen in their advertisements online. SoFi is been a rock solid grower in terms of revenue. They grew 61%, then 52%, then 51%, and they maintained their over 50% growth rate yet again in their most recent quarter, while making nearly $500 million in revenue during that time. This is despite the macroeconomic turmoils that we've seen with some smaller banks even shutting down in the news recently. For example, Signature Bank, which is a company that I actually used to invest in, I think like 6 or 7 years ago, went out of business in New York just earlier this year. Now, despite this, SoFi is still up 26% year to date in terms of their stock price, and at their current valuation, I'm still comfortable holding a decent sized position in this company. Next up, we have another stock which I don't yet own, but make sure you watch till after this one when I'm going to tell you the latest trade that I made in the past year. Next up, we have GLBE, which is actually a company that I used to invest in if you look at some of the early videos on this channel. GLBE enables sales, and they have especially been focused on the international market. Basically, different markets have very different types of marketing and sales that are appropriate for the environment. A certain type of marketing that works well in Southeast Asia might not work as well in Mexico, which might not work as well in Britain. Because of that, GLBE offers services to actually localize your marketing and sales to a specific region, and by doing this, they drive really good results for their customers, which are very clear in their earnings numbers. If we look at GLBE's revenue over the past year, they have actually been accelerating revenue growth. 2 quarters ago, they grew 65% year over year. Then they grew 78% year over year. Then they grew 69% year over year. This is a company that's not only making more and more revenue every quarter, they're actually increasing the rate at which they are growing that base revenue. Now, the company is not yet net income profitable. In their most recent quarter, they also reported that they were both non-GAAP profitable, making $57 million, and they were GAAP gross profitable, making $55.8 million. Some interesting partnerships they've also been engaging in recently. They went live with Disney EU this quarter, representing a major expansion in their relationship with Disney. They also strategically partnered with Shopify, offering a native integration that allows merchants to use their platform, as well as offering a white-labeled version of their platform that they're currently trialing, which could be used by Shopify customers as well. Now, you may notice some trends in the stocks I'm investing in: data, security, fintech, but I also like to invest in assets completely outside of stocks. For example, I own my own home, and that's a form of investment in real estate. Because no matter how promising a sector or the market in general can look, something can always come out of nowhere and completely destroy your gains. In the last year, stocks, bonds, and even real estate saw some historic lows that we haven't seen since 2008. But at the same time, it was a huge year for alternative assets, with some money managers even shifting their attention into those assets. And today's sponsor, Masterworks, is giving you access to one of the most exclusive alternative assets of all: contemporary art. In 2022, according to Barron's, art prices appreciated 29% at auction on average, allowing Masterworks to pay out over $25 million to their investors. And the best part is those investors didn't have to do the legwork of finding the art, because Masterworks did it for them. Masterworks buys artwork from people like Picasso, Banksy, Monet, and then does the legwork up front to qualify them with the SEC, break them out into shares, and allow regular investors like you and me to invest in them. And every Masterworks exit to date has made a profit. We can take a look at their performance, and the results kind of speak for themselves. With nearly 700,000 users, Masterworks offerings have sold out in minutes many times. They even had to make a wait list for new users, but because they sponsored this video, if you sign up using the link in the description, you can skip the waitlist and sign up today. Now, I told you that after that stock, I would let you know what trades I've made recently. So my most recent trade was made at the end of February 2023, and that was buying $6,000 in CrowdStrike, which is another cloud security company. Now, I'm not going to talk about that company too much in this video, but you can watch my previous video on CrowdStrike if you want to see a breakdown of that stock. So now back to another stock that I do own. We have Cloudflare, which is my 3rd largest position overall, and I have 317 shares of the company valued at nearly $19,000. And while Charles Schwab shows that this is a loss overall, this is because of the way Charles Schwab does their accounting is based on first in, first out. So I actually sold some of my Cloudflare and then bought more of it at a higher price, which makes it look like this is a loss, even though in the long term, I actually had a profit in this stock. Now, Cloudflare, in my opinion, is the most innovative company in the world. They started out offering basic website protections, think firewall, but then they realized if they're already monitoring all the traffic going in and out looking for bad actors, why don't they optimize that traffic for good actors as well? So they started offering more and more features that would improve websites. Then they moved beyond simple websites into web applications, providing infrastructure for those apps to run on. At this point, Cloudflare is actually starting to compete with some of the large cloud providers like Amazon, Microsoft, and Google, which is something that would have been unheard of a few years ago. One of the ways that they've done this is they've maintained a rock-solid 50% growth rate year over year for basically the last half a decade at this point. Now, in their most recent quarter, their revenue growth rate has started to slow, but Cloudflare is committed to 5xing in size over the next 5 years, which which would represent, I think, around a 37% year-over-year growth rate on average. So they clearly have a lot of runway in front of them. Next, for a stock that I don't own, but I do think is worth looking into, is Microsoft, which is a bit of a weird one because this is not a top stock based on their earnings numbers, which is usually how I like to invest. If we look at Microsoft earnings, now these are delayed by 1 quarter because they just issued earnings as I'm making this video, but we can see that a year ago they were growing at 18% year over year and making nearly $50 billion, and today they're making just over $50 billion, but they're not really growing that quickly, which is why I say this is a weird one, because by all accounts, Microsoft is a very mature company, but the reason that I would invest in this company is based on a single product they're creating, which is usually the sign of a bad startup that's getting overhyped, only in this case, it's not a startup, it's Microsoft. Now, obviously the product that I'm talking about is ChatGPT and OpenAI. Microsoft owns a fairly substantial stake in OpenAI, and they have one of the first integrations into the OpenAI SDK, which is a software development kit. Essentially, any company or enterprise that wants to make use of OpenAI's technology but doesn't want to send all their data to OpenAI is going to need to use Microsoft's SDK to actually access that functionality. Now, while there are going to be competitors, Google's working on Bard right now, as of right now, Microsoft is miles ahead of the competition in terms of most of the things that enterprises would actually want to use this for. And considering Microsoft's whole business plan seems to be focusing on enterprise customers right now, that puts them in an extremely powerful spot moving forward. Next up, we have my second largest stock overall, and make sure you stick around to the end to see my largest stock. My second largest position overall is a company that I've owned for a while, and that is Datadog. I own 330 shares of Datadog, valued at just over $21,000, and this is down around $10,500 off my initial $32,000 investment. Again, that's mainly because this is a high growth stock and a tech stock, both of which have been industries that have been hit very hard by the market recently. Now, Datadog is a data company. They unite a company's applications, their infrastructure, and their security all through a single pane of glass. Now, if you've heard me say that before, basically what that means is that they take a company's data and make it easy to access. And this is helpful because it can help you see areas of the company that you could optimize more or see areas where you should be investing more. But it's even more powerful when you tie it into AI. AI, like OpenAI's ChatGPT, is able to read plain text data very easily. It can look at a screen and read data off the screen. If all that data is gathered into one place for it, it's able to do analyses for you. Now, it's not able to gather that data that easily at this point. All those integrations still have to be built, but guess who's built them? Datadog. This means Datadog is positioned well as a hyper-growth company, as a data company, as a cloud company, and even as an AI company going forward. This is basically 4 different roads all intersecting right on Datadog, and it's one of the reasons this is one of my largest positions overall. Before we get to my largest stock position overall, I'll do one more kind of stock that I also invest in, and that is VFFSX, which is a Vanguard index fund that tracks the S&P 500. Even though I talk about individual stocks a lot on this channel, most of my money I actually put into index funds, and that's because if you invest 15% of your income into retirement accounts over a long enough time horizon, you can almost guarantee that you're going to retire with enough money to live on. And that security is what allows me to take bigger risks in the stock market and potentially make bigger returns. So with that said, let's now get into my single largest stock position, which is currently Snowflake. I have 160 shares of Snowflake valued at over $22,000, and that is down off an initial investment of almost $30,000. So it's down around $7,000 overall. Now, Snowflake, similar to Datadog, is also a data company, but they're operating more in what they call the data cloud. You can almost think of the data cloud like a super upgraded version of a data warehouse, or how a data warehouse was an upgraded version of a database. They think it represents the next leap forward in database technologies, and their numbers seem to be backing it up. Snowflake made almost $600 million in revenue just in their last quarter, meaning they're making over $2 billion a year. And despite that, they grew over 50% year over year in their most recent quarter. This is a company that also has incredibly sticky customers. On average, their customers spend something like $1.60 more with them next year than they did the previous year, showing how much they like the product. Snowflake has also managed to make themselves even more sticky by offering what they call data edges, essentially edges shared between different customers that they have, where those customers can share data with each other. This means if one of those customers wants to leave Snowflake, they suddenly lose access to all that data that they had built their business around. Imagine a group of pharma companies all collaborating together on a drug. Well, one of those companies can't just leave Snowflake's platform because they'll lose access to all that data that they had created and shared with the other companies. And I don't have to rehash it here, but when you have cloud and data in the same sentence, you know AI is going to play a major role in this company's success going forward. Make sure to comment below which of these stocks is your favorite, and let me know if there's another stock that you think I should be looking into. Don't forget to like and subscribe, and I'll see you next time.